Today, we're talking about something that almost everyone will deal with at some point, a mortgage. If you're thinking about buying a home in Ontario, or even if you just want to understand how the whole thing works, this video is for you. So, what exactly is a mortgage? How does it work? And what do you need to know about getting one in Ontario? Well, let's break it down into simple terms so you can feel more confident about the whole process. Let's start with the basics. A mortgage is just a fancy term for a loan you take out to buy a home. When you buy a house, most people don't have enough cash to pay for the whole thing upfront, right? That's where the mortgage comes in. The bank or the lender gives you the money to buy the house, and you pay them back over time with interest. Basically, it's a huge loan that you use to buy a property, and in exchange, you agree to pay back the money plus interest over a certain number of years. In Ontario, mortgages are pretty common. Whether you're buying a condo in downtown Toronto or a house in the suburbs, you're likely going to need one. So how does it actually work? Here's the deal. When you apply for a mortgage, the lender will look at your credit score, your income, and your down payment to decide how much money they're willing to lend you. The larger the down payment and the better your credit score, the better the deal you'll usually get. And once you're approved, you'll get a mortgage loan agreement that lays out the terms of your mortgage. Things like how much you're borrowing, called the principal, the interest rate, this is the cost that you pay the lender for borrowing the money, and the length of the loan. Most mortgages are 25 years, but you can make it shorter or longer depending on what you agree. So here's what those terms mean. The principal, this is the amount that you actually borrow from the lender. For example, if you're buying a home for $500,000 and you put down 20% down payment, the principal will be $400,000. Interest, this is how much the bank charges you for borrowing the money. You'll typically see two types of interest rates: fixed rates, where the rates stay the same for the entire term of the mortgage, and variable rate, where the rate can change over time depending on the market conditions. Term, the length of the time you commit to paying back the mortgage on those terms. Typically 5 years in Ontario, but then you'll need to renew or refinance at the end of term. All right, now let's talk about repayments. So every month you'll make a mortgage payment. This payment usually covers a couple of things: the principal, when you're paying off the loan amount itself. With each payment, you chip away at the $400,000 or however much you borrowed. And interest, you're paying for the privilege of borrowing that money, which can add up over time. Early on in your mortgage, most of the payments go towards the interest, but over time, more of it goes towards the principal. And side note, there are also things like property taxes and home insurance that you may have to pay separately, or sometimes those costs are bundled into your mortgage payments. Okay, now down payments. Let's talk about those. In Ontario, you usually need a minimum down payment of 5% on the purchase price if you're buying a home that costs under $500,000. But if the price goes over that, you'll need a bigger down payment. For homes that cost over $1 million, you'll need at least 20% down payment. If you put down less than 20%, you'll likely need to get mortgage insurance, which is often called CHMC insurance, which protects the lender in case you default on the loan. This is an extra cost added to your mortgage, and it can add up. So let's quickly go over the steps to get a mortgage in Ontario. First, you'll need to get pre-approved. This is a super important step. It means that the lender will look at your finance situation, income, debt, credit score, and tell you how much they're willing to lend you. It helps you know your budget and makes you more attractive to sellers because you're already approved for a loan. Once you know how much you can borrow, you go out and find your dream home. After you've made an offer on a home and it's accepted, you apply for the mortgage. At that point, the bank will do a deeper dive into your finances and the property before finalizing the loan. Once everything's approved, you sign the mortgage agreement and you get the keys to your new home. From there, it's just about making your regular payments until the mortgage is paid off. Here's a few things to keep in mind about mortgages in Ontario. Mortgage rates can fluctuate, so it's important to shop around for the best deal. Mortgages in Ontario are 25 years, but you can choose a shorter or longer term depending on what works best for you. Some mortgages allow you to make extra payments or pay down the principal faster without penalties. This can save you money in the long run. So that's basically how mortgages work in Ontario. Whether you're a first-time buyer or someone looking to upgrade, understanding how mortgages work is super important so you can make the right decisions. It can feel like a lot at first, but once you break it down, it's pretty straightforward. And if you found this video helpful, don't forget to hit the like button and subscribe for more tips and real estate advice. If you have any questions about mortgages, drop them in the comments and I'd be happy to answer. Thanks for watching. See you next video.